As we continue through Chapter 2, now we've gotten to the trial balance. So first, we analyzed transactions, we recorded journal entries, and then we posted journal entries into our accounting ledger. After all of that is done, at the end of the month or year or quarter, we do what is called a trial balance. What a trial balance does is we list every single account that we have open and its current balance. We then add together all of the debits and credits to make sure that they equal. If they don't equal, then we have a mistake in our accounting records that needs to be fixed before we can prepare financial statements. Because if our trial balance doesn't equal, it means that our balance statement also won't equal. So the trial balance is a check. On this slide, we see an example of a trial balance. As I said, all of the accounts are listed and then with their debit or credit totals. If we have to find errors, we have a different couple of things that we do. So first, we just want to make sure the columns were added correctly. So we're going to double check our math. Then if our math we checked all of our math and there's still a problem between the debits equaling the credits, then we have to go check all of our account balances and make sure that we typed them all in correctly. If we got all of the balances correctly, then we have to go back to journal entries and start looking, were journal entries properly posted? Were they properly recorded? Did all of our journal entries have equal debits and credits? So different things that we have to look at. There are a couple of tricks to identify where to look in the errors, because really thinking about this, going through all of our accounts one by one and all of our journal entries one by one, trying to find where the mistake is sounds like a lot of work. There are two tricks to help find errors. So the first is to divide the difference by 9. If whatever the difference is, so we subtract debits minus credits, we get the amount that our trial balance is off. And if that is equally divisible by 9, means that we get a whole number with no decimal points, this tells us that we have a transposition error. What a transposition error is that we flipped numbers when we were recording them. For example, instead of 59, we typed 95. Okay, so if it's equally divisible by 9, this tells us that we need to find a transposition error. This helps us to know what to look for when we're looking through our ledger and our journal entries. If it doesn't divide by 9, but it does divide by 2, this tells us that a debit or credit was entered incorrectly, which means that we were supposed to enter a debit and we entered a credit, or we were supposed to enter a credit and we entered a debit. So this tells us so these are just two tricks to help you find errors quickly, rather than just spending a lot of time digging through all of your accounting records trying to find the mistake. As I said earlier in financial ratios and financial analysis, when we were talking about in another video, each chapter introduces a couple of financial ratios at the end. And then in the very last chapter of Principles of Accounting 2, we bring all of those financial ratios together and do financial statement analysis. You will also see these financial ratios in business finance and in your senior seminars for your program. Okay, so the first financial ratio at the end of this chapter is return on assets. Return on assets is sometimes also called return on investment. So what this is looking for is how well we use assets to generate income. So the things that we own, our properties, our buildings, our equipment, how well are we using that to generate income for the company. So the equation for that is return on assets equals net income divided by average total assets. Anytime it says average total assets, what that means is it wants the beginning of the year total assets plus the end of the year total assets divided by 2. If you do not have 2 years of total assets, the beginning or the ending, then you would just use the total assets number that you have, because if you add them together and divide them by 2, that's the result that you would get. So here we see some examples of return on assets for Nike and Under Armour. And we can see that Nike is improving their return on assets while Under Armour is decreasing. They are not doing as good of a job as Nike at improving their return on assets. That's called benchmarking, when we compare ourselves to another company to try to determine if our results are comparable within our industry or with people that we're competing against. The next financial ratio is the debt ratio. So what the debt ratio looks at is how much debt a company has taken on. If they have too much debt and they're not able to pay their bills, and whether or not they're a good financial risk. So what the debt ratio looks at is if a company comes to us and they're asking for money, say we work at a bank and they're coming to us for a bank loan, we're going to look at this debt ratio and we're going to say, how much debt do you already have and are you able to pay off your bills? Okay. The higher the debt ratio means that there's a higher likelihood that we won't be able to pay our bills. Another thing is you absolutely want that debt ratio to be under 1. A debt ratio that is 1 or higher is a very bad indicator of the financial shape that a company is. This means that they are carrying a high amount of debt and they are not in a good financial situation. So the debt ratio is calculated by taking total liabilities divided by total assets. So what this does is we want our assets to be higher than our liabilities. So remember, the assets are the things that we own that provide benefit for our company, and liabilities is what we owe or have to pay other people. If our liabilities are higher than our assets, that number is going to be bigger than 1. Which is not a situation that we want our company to get into. You can see in this example, we're comparing Costco and Walmart. And you can see that Costco has a slightly higher debt ratio than Walmart does in this comparison. That is the end of chapter 2.